Actually, it is difficult to know exactly how many transactions are made daily. Volume, on the other hand, can help us estimate this transaction in a number of ways, though its most significant use is to help identify strong support and resistance level in the market, and this can help you judge the strength of the price movement or momentum. Volume helps us measure supply and demand rates and how this can affect the market price in the future. Volume in cryptocurrency trading refers to the number of coins that change hand on a given day in the market. Hello, I am Bitcoin Gorilla. Welcome to this video class on volume. I will make you understand the importance of volume, how to identify it, how to implement it in your trading, and how to use it to judge false breakout and real breakout. And again, how volume can help you filter your trade entries, like your setup, your choices, what trade is worth taking and what trade is not worth taking. Talk about 24 hours volume in cryptocurrency trading. We are referring to the number of coins that has changed hands on a given day in a crypto market. In the cryptocurrency futures market, it refers to the number of futures derivative contracts that are traded in that day. Every particular transaction is carried out as a result of demand being met by supply. But when demand exceeds supply, prices tend to rise higher and higher, and conversely, when supply exceeds demand, prices tend to collapse and fall downward. Now you might ask me, what is the cause of supply and demand? Like simple economics say, supply comes from the sellers growing in number, demand comes from the buyers growing in number. So you see, when either of these two parties overpowers the other one, who has more strength to grow? Like I said, in cryptocurrency, volume helps us estimate the stronger support and resistance, because when we're talking about support, we are talking about the chances that the demand in that zone will withstand the sell-off that has been going on before then, right? And when we're talking about resistance, we are talking about the zone where the sell-off is stronger and can withstand the buy power that has been going on for a while, right? So there are many different ways to visualize volume and price relationship. Why some schools of analysts think of volume as a judge of price and market pressure, but for me, it is the more visual aspect of trading. Let me illustrate. So further, I would like you to picture a water pump, and a plastic ball is placed in front of the water hose. Of course, we know pressure has to be applied for the water to pump, right? So with the pressure coming from the water hose, we place a ball pointing skyward just above the garden water hose, right? When we turn the water on, if the pressure continues, we will see that the ball will shoot upward to the sky. As the water hose pressure rises, we will see the ball tend to move higher. What happens when we turn down the pressure from the water hose, right? We see the ball move higher for some couple of seconds, maybe 3 seconds or so, before instantly falling back down. Price needs increasing pressure from volume from both buyers and sellers to make a move. If there is a pressure coming from the buyers, then price will continue to move upward. But what happens when this pressure ceases to come in? The price will move up a little, but then it will fall on its own weight, just like the ball. So the ball will fall without the pressure. So will the price fall without the volume. Understand how volume and price work. They are like two opposite sides of the coin. Without volume, price will not move. We see that the ball couldn't continue on its own without increasing the water pressure. And likewise, we see how easily price decreases as there is no volume to accompany it. Price will continue diminishing until new buyers come in. To understand volume, we must first of all understand the basic rules of volume analysis, which includes the following. When prices are rising and volume is increasing, be rest assured that the present trend is most likely to continue, as the increased volume signals demand volume. That is, more buyers are coming into the market, therefore prices is expected to continue rising upward. The second rule states that when prices are rising and the volume is decreasing, it is said that the odds are most likely the present trend will not continue. Therefore, the prices rise will likely decelerate and turn downward or fall. Now, this is a very important. When prices are rising and volume is decreasing, we say what? Very soon, likely the price will change direction and follow the volume and fall down. That is the simple rule of number 2. So the rule number 3 says when prices are falling and volume is increasing, the present trend is most likely to continue falling as the increase in volume is likely signaling supply volume. Don't forget, we have supply volume, we have demand volume. You must understand when supply volume is growing and when demand volume is growing, so you don't mix it up, right? So price will continue to fall when there is an increasing volume in price and price is already falling. It means the volume you are seeing is the seller's volume. Rule number 4. When prices are falling and volume is decreasing, the present trend is likely to continue as it is expected that the price decline will decelerate and the price will continue upward because the supply volume has decelerated. So let me explain this. Price is falling and volume is decreasing. What does that tell you? It's like saying there has been a long period of decline in price and price has gotten to a point whereby the volume of sellers, the supply volume, is beginning to diminish, is beginning to dry up. What does that tell you? Soon buyers will come in and change the trend, because it looks like when the supply volume is drying up, chances are high that the demand volume will come in and pick up. So it is likely that the downfall will not continue. It means that price has gotten to a support level. So how do you tell when sell-off is beginning to dry up? It's because the amount of volume in terms of the demand is beginning to rise up to meet the sell-off. There, first of all, there will be an equilibrium as all the buyers needs to take out all the sellers' order, and once they clear the seller's order, the road is clear for them to move higher. So what we're going to see is a period of sideways consolidation after the diminishing volume. That diminishing volume is likely why we see what is known as trading range or consolidations. This trading range or consolidations are formed as a result of diminishing volume in a falling market or a diminishing volume in a rising market. Now, when it's diminishing in a falling market, we're talking about diminishing of supply volume. But when it's diminishing in an upward market, then we're talking about diminishing of demand volume. So in the law of number 4, we are talking about diminishing of supply volume. Meanwhile, when we talked about law number 2, we are talking about diminishing of what? Demand volume. So know the difference. So law number 5 says when the volume is neither rising nor falling, the effect on price is absolutely neutral, and as a result, price experience what is called trading range. I just mentioned that. If you know what a trading range is, it's formed as a result of equilibrium between buyers and sellers, a momentary period of equilibrium as they will drag between themselves. In order for price to move whether up or down, buyers and sellers must overcome each other in terms of volume. When there is 56% of buyers and you have 44% of sellers, we see there's more buyers, but the change in the price might not be so obvious, right? The reason it's not so obvious is because there's a little bit of equilibrium. So what happens when we have 50% of sellers in the market and 50% of buyers in the market? You see that there are others, they will neutralize each other, right? And when they neutralize each other, we have what is known as a trading range. And a lot of times this results into anxiety, depression, and a lot of emotional pain for so many traders. So this is why I always advise students to avoid trading when the volume is neutral, especially in a trading range or a consolidation. How can you implement these volume rules to your trading? Let's look at some illustration to help us better understand this. Let's say Bitcoin has been in a trading range for several weeks with an average daily volume of 50 million BTC changing hands. Then prices begin to move upward as the daily volume picks up to 80 million BTC traded daily. With this, it is justifiable to believe that prices is most likely to continue upward and move higher, as this is said to be fueled by what is known as demand volume, because we're seeing a rise in volume. As expected, price did continue to move even higher the following weeks, but after 6 weeks, we see price tumble and lose like 35% of the previous move, right? At this point, the obvious questions now are start rising in your mind. Should I sell my Bitcoin? But again, the clue we need lies in the volume. Going back to the volume picture, we notice that during the fallback, BTC has been trading around 30 million BTC per day. You can see the volume has dropped from 80 to 30. With this information, we bring our volume rules to the board. We can summarize that this is most likely a temporary reaction in the market, but if the upward move is likely going to continue, then what might be the source or cause of this reaction, you might ask? What is actually happening in the marketplace? There could be a lot of factors or reasons that could have caused this. That probably maybe early buyers are taking profit, or new buyers could be waiting for a setback opportunity or a pullback opportunity to enter the market. But again, all these are healthy reasons for any market correction, and therefore not a good reason to abandon our trade position just because we see a first pullback, unless we notice that on the down days the volumes begin to increase. So back to our BTC, we see that as expected by week 7, the prices recovered and again started shooting up once more. We see that the volume again increases. This time, 95 million BTC are being traded daily. By week 8, the volume continues. The same thing happened by week 9, bringing yet another reaction in price as we see volume all the way dropping down again to 50 BTC. Another reaction downward. We still hold our Bitcoin. Of course, we'll still hold. We need a confirmation to believe that the trend is no longer going up and now could be going down. As prices continue to rise, making new highs, but oddly enough, now we're noticing volume is no longer rising with the price. Instead, we're seeing volume averaging around 50-60 million BTC per day. Even the next week, we saw 65 million BTC per day. We see a clear change in volume signal, signaling strong warning. As we see, demand volume is beginning to dry up. Even though new demands may still come into the market, but remember, our volume rule says when price is rising and volume is falling, chances are high that at some point, remember our rule number 2, it said when prices are rising and volume is decreasing, it is said that the odds are most likely that the present trend will not continue. Therefore, the prices rise is likely going to decelerate and turn downward. And like we see, price keeps rising, but volume now is decreasing. In our situation, that is a clear warning. As expected, price tumbled down the next few days on a very heavy volume. Obeying the rule has got us out of that trade early. Let's look at another scenario, and this is quite a very deceptive scenario. A lot of people fall victim of the trap that comes with the sellers, right? What if prices has been in a sideways? Let's look at this scenario. What if prices has been in a sideways, trading in a trading range for quite some time, and then price begin to fall on a low volume? Should we call this a breakdown, move to the downside, or a forced move to the downside, or a forced breakdown? It is occurring on low volume. To anyone we say no, it's going to come back up. Not necessarily, because although prices must be accompanied by a strong volume, we're moving to the upside to confirm the legitimacy of that move. Be warned that down moves occur or begin on very light to little or no volume as a result of the market falling under its own weight. So it's important to be aware that volume usually tend to be lighter when prices are falling and breaking down, but as the breakdown occurs, the volume will pick up and grow. That is, the supply volume is beginning to show off. But most people are expecting the volume to show up first before the breakdown, but it always goes the other way around. That is the trick that sellers play, right? but it's not the fault of the seller. Like we said, notice that the ball kept moving for like 2 to 3 seconds before diving down. Now the ball has to fall on its own weight without needing any pressure from neither the water hose or the water. Another wonderful phenomenon about volume that seems to be baffling technical analysts is the fact that market tops tend to be formed on heavy volume. Oftentimes, they call this climbers, which usually occur after the market has been moving upward for a long period of time. Now, climaxes occur with a forceful volume just before a change in direction takes place. Now, the change in direction is going to be twice as forceful as the move up. So we can say it can occur on both tops and bottoms. Climbers, oddly enough, till this day still puzzle technical analysts and traders. Here we see that if we look closely and observe the market price action, it might help us make some sense of the situation to determine if the climbers can be trusted or not. You see, unlike stocks, commodity and the bond market, cryptocurrency exchanges like Binance operate 24 hours a day and 7 days a week. Let's say that the typical market makes new high in the morning, accompanied by strong heavy volume, but then we observe that by afternoon the prices start to drop gradually, but the volume still remains heavy, therefore producing something that looks like a reversal day, giving us a classical example of what is known as distribution phase. Now don't worry about distribution phase because we have already made a video about price life cycle. You need to go and watch that video on price life cycle. It will give you a full understanding of the life cycle of prices, the phases, different phases of prices, right? On the reversal day, we're going to be seeing something that looks like a distribution phase. This is a phenomenon that occurs when the previous owners of a cryptocurrencies are dumping their coins and taking profit. But then, to who? Who is buying these coins that people are dumping? The journey just come ladies who are so ignorant and unaware that they are buying the top from the previous owners of the cryptocurrency who have made enough profit and they feel that it's time to run. Who have been buying, holding for weeks, months, and by now they have too many coins to distribute than this journey just come ladies can probably handle, therefore leading to supply volume overcoming demand volume, creating a crash, a price crash, and a new buyers are left holding these coins that are now worth nothing. The journey just come ladies who are so ignorant and unaware that they are buying the tops from the previous owners of the cryptocurrency who have by now have been buying for a long time, have made good profit, and they feel that it's time to get out of this market because something bad is coming. But this journey just late comers don't know anything. They are ignorant and they will go ahead and feel like this big green candle I'm seeing is a huge buy opportunity, volume is coming into the market, therefore I am going to buy. So they go ahead and they buy it from these people who have been holding this coin, who are aware that the market is about to crumble, therefore leading to supply volume overpowering demand volume, creating a price crash, and the new buyers, the latecomers, are left holding these bags that they will have to hold for quite some time, and at the end of the day most of them end up selling in panic. The phenomenon can easily be described as what traders are meant by buying the top, and when they say cryptos are moving from strong hands to the weaker hands. Bottoms, on the other hand, literally does the opposite patterns to top, as it mostly occur on very light volume. So we're talking about bottom here, we're talking about light volume. As volume tend to dry up when bottom is occurring, indicating that supply volume has diminished and the sell-off pressure has lessened. So at the top, we're seeing more volume before the crash. At the bottom, we're seeing lesser volume before the change of trend, right? So bottom always does the opposite of what tops does. Yes, you can see climax in the bottom as well as the top, but they play different roles here. Bottom, on the other hand, literally does the opposite. Like I say, as volume tend to dry up when bottom is occurring, indicating that supply volume has diminished and the sell-off pressure has lessened, meaning demand is going to rise. And if you check, that is our law number 4 that says when prices are falling and volume is diminishing, the present trend is likely not going to continue, as it is expected that the price decline will decelerate and the price will turn upward because the supply volume has decelerated. So in our situation of bottoms, we see that the price is falling, volume is decreasing, which means not long before we see a reverse and price will shoot up. The traditional way that technical analysts represent volume graphically is in the form of bar chart directly beneath the chart, but you can always look at volume in multiple different ways, like using a continuous line rather than a chart. In summary, an understanding of volume pattern adds a third eye dimension. An understanding of volume pattern is like a third eye dimension added to your focus and enabling you to see the hidden third aspect of the whole dimension. See, in summary, an understanding of volume patterns add a third eyes to your focus and enable you to see behind what is hidden to so many traders. You tend to now focus more attention on confirming your breakouts and breakdowns, because it's expecting that when prices break into the upside, it should be accompanied with enough volume. But when prices break into the downside, remember, it can happen on a light volume or on a high volume, or it can start with a light volume and the volume increases as the down move increases. The rule is very simple. I say, never you trust a breakout that is if not accompanied by a significant increase in volume. The rule is very simple. I say, never trust a breakout that doesn't. The rule is very simple. I say, never trust a coin price breakout if that coin price is not accompanied by a significant increase in volume. While some school of thoughts believe that there must be first be a spark in volume that shows the final panic dumping of the coin, they feel that volume should then contrast and dry up to show that the selling pressure has lessened. Now we're talking about bottom here. Some people believe that first they need to see these climbers, this spark in volume. A lot of people fall trap of that. Mostly market makers do this. There is this sudden last dump that clears all the people who jump into buying too early before the real move starts. In reality, anything can happen. But while this is a nice theory, the reality remains that there is far too many charts with different volume formations that turned out to be big winners today. So let's keep things simple but yet profitable, but not by not worrying about the shape of the volume, and instead focus on what happened during the formation of the trend or pattern and the breakout of price pattern. It must be accompanied with something from the volume side. However, once the price breakout above the top of the resistance of the accumulation formed after a long period of dump, we're still on the bottom aspect now. However, once the price breaks out above the top of the resistance of the accumulation or trading range, that is during bottom formation, we say, I want you to worry plenty. However, once the price breakout above the top of the resistance of the accumulation formed after a long period of dump, we are still talking about the bottom here. So I want you to worry plenty about volume from that moment the breakout occurs from the consolidation. Now, while the consolidation is forming, while the sideways movement is going up, you have no worry about volume. It's none of your business, because chances are high that the volume will be drying up and the volume will be lessened. But if they happen to be a breakout candle above that range of the consolidation and is not followed by volume, very suspectable of that breakout. Volume should spark and pick up significantly on that breakout. If it doesn't, the odds and probability are very high that you have got a mediocre winner, which might in advance, it might advance a little, but then it won't go far, and then it will crash back down into the consolidation and sometimes even break lower to the other side and could change direction and continue the dump. I don't believe there is magically any level of volume or pattern necessary to identify a winner in the crypto market than looking for breakouts in coins that have randomly picked good number increase in volume when compared to their past volume. So if you compare to the past, what is the increase like? It should be at least like four times or 6 times the average of the last few days or last few weeks. So here I say I look for either a weak volume spark that is at least twice the average volume that I've seen in the past 1 month or 2 months or 3 months, but preferable it's even higher. It's preferable if I have a higher volume. Or you look at volumes build up on the coin over the past 3 to 4 weeks. That is at least twice the average volume of the past several weeks, coupled up with at least some increase in the volume on the breakout week. The most important thing is the breakout time, the time of breakout, especially if you're dealing with a bottom, you're trying to buy the bottom. You must wait for a good increase in volume to justify that move up. It can easily be done. You can easily monitor volume using coinmarketcap.com, because there every 24 hours volume is being compiled from different exchanges, and you get the final volume, though it might not be the exact number that has been traded, but it's an estimated number, so you can work with that. CoinMarketCap can help you monitor on daily basis. You will know how the volume increase. Like personally, I go to CoinMarketCap, and whenever I'm doing my fundamental analysis, I take my time to look at the volume. What has the volume been like this week? What has it been like last week? I keep track. I sometimes like jotting down the volume I see, especially when I start seeing a flat volume. A flat volume for a long period of time signifies equilibrium, signifies trading range. So whatever the exact number is, if there's no significant increase in the volume when the breakout occurs, then I say run. I say avoid such a coin. And if you have purchased it with a buy stop loss, that's okay to sell it for at least fast profit when it advances, because most times after the pause there's a little advance before the dump continue. So that is my view on volume and how I manage volume. I remain Bitcoin Gorilla. Thank you for watching.
It's only worth it if you work for it. It's only worth it if you work for it. I won't stop till they hear me now. I won't stop till I wear the crown.